Hey everyone, happy Monday. Welcome to the final bar. We'll talk about an S&P sort of distributing today, rallying really in the afternoon session with technology leading the way higher, sort of tech and everything else today, with financials and energy sort of leading the way to the downside. You have dollar weakness, bonds at an interesting inflection point with a potential for a bit of a rally into resistance for the TLT. We're going to look at all those themes, big picture level, then go through sectors and individual stocks. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close as we look at the charts together, focus on the message that the charts can provide in terms of understanding investor psychology, where investors are excited, euphoric, desperate, despondent, all of those adjectives to describe investor behavior. And that's the benefit of charts, is quantifying that investor psychology, understanding where people are leaning. In terms of where they've been leaning today, energy certainly the story in the equity space, or one of them in terms of leading to the downside. A lot of the energy stocks, when I was looking at individual stocks over the weekend, you can see them coming out of an overbought condition really into the last week. And so, not too much of a surprise after the run you've seen in energy. Also in financials, a lot of names in those sectors coming out of overbought conditions. That's a reasonable expectation for a bit of a pullback. The real question is going to be what comes next, right? What comes after that? And I think the leadership that you saw in technology today, particularly with semiconductors, shows you that investors are treating that as a safe haven, much like we've been talking about for a while here. So it's playing out kind of how you might expect on a bit of a corrective move today. We have some great guests today. We're going to focus on the charts. Tomorrow we have Sean McLaughlin from Trade Ideas and All-Star Charts joining us. He's an options expert, so it should be really interesting to hear his take given the choppiness that we're seeing in equities. On Thursday, we'll have Ari Wald from Oppenheimer coming back on the show to get his take on big picture themes going into year end. And then, just as a teaser, the week of December 21st, we are going to enter into our end of the year programming. We have some fantastic special events, all with the theme called Reflections 2020. We're going to have experts talking about how they wrap the year in terms of debriefing on their performance. We'll have 10 different experts providing their chart that best represents the year from their perspective. It's going to be a lot of fun. I'll talk about sector rotation, a whole series there. So it's going to be a lot of fun. We have a lot of special guests and a lot of familiar faces and names from the Stock Charts community. So make sure you check that out. It's called Reflections 2020, starting on December 21st. Let's get to our market recap. The first piece of our three-pronged approach is to talk about the macro environment, top-down macro, and see what themes we can tease out. I want to start very quickly with a survey that we ran last week on the Stock Charts TV page. As a reminder, anytime you go to stockcharts.com/TV, also on our YouTube channel and our Twitter handles as well, we'll send out some polls and take a minute, answer those, because it's a great way to just keep a conversation going in terms of what you're seeing and what's important. What we asked you recently was, how important is sentiment? Things like the AAII survey, the name exposure index, and elsewhere. How important are those things in your process? 39% of you said somewhat important. 18% of you said very important. 21% not very important. 21% of you say I literally never look at these things. So if you asked me, I would probably say somewhat important. That's about where I would throw my vote as well. And so I think agreeing with the plurality here. To be honest with you, we've talked a number of times how for me the macro process is price, then breadth, then sentiment, and it's in that order. And the number one thing has to be price, because that's the best representation of what investors are thinking and what they're doing. Breadth confirms that. That's a way of understanding, sort of looking under the hood and understanding what is causing some of those movements. Sentiment for me is usually more anecdotal. I would not design a trading system based on an AAII survey. I just don't think the data to be honest, is robust enough to really validate that. However, I do think it's a really important measure of the overarching psychology, right? What investors, what the masses are thinking, what's the broad perspective out there. And I find it can be really helpful, especially at inflection points, because sentiment is sort of your early warning system that tells you when something might be awry, and then price and breadth are what confirm it. The reason why that's an interesting question now as we get to our market recaps, because if you look at most measures of breadth in the last couple of weeks, they've gotten to euphoric levels. Things, the name exposure index, we can start there here, going to our sentiment list. The name exposure index tells you how investors are positioned. And on this chart, I'm looking at the name exposure index, also the RIDEX fund flows. So it shows you within the RIDEX family where investors are leaning. And you can see it's over 100% long on the name exposure index. And while that on its own does not tell you we're topping out, that's just it's an early warning system. It tells you the conditions are similar to previous periods where the market's rallied so much that investors, active managers, are over 100% long. That usually is more common with market tops than early stage bull market rises. And so, that the fact that sentiment has become so extreme positive, I think, is an interesting data point that should fuel your analysis of price and breadth. Let's continue on with our discussion of the big picture. Let's look at the member dashboard here. So as I mentioned, sell off in the morning, but a nice accumulation through the course of the day for the S&P, finishing about 0.5% down, just above 3620. The Nasdaq essentially flat, moved around a bit, but essentially finished flat for the day when all was said and done. Rallied back to close at that level. Mid caps and small caps down even more. So this is certainly a rotation away from that late cyclical leadership, small cap outperformance. All of those themes sort of pivoted back. Conservative, or not conservative, that was an interesting way to phrase that, but the bellwether sector of technology sort of getting it done today and keeping the S&P less negative than it could have been. The VIX back down around 2050. Interest rates, we're going to talk about the bond markets here in a moment. I think the TLT chart is an interesting one, sort of chopped around today, but, yields have gotten to that point where you could see, the bond prices have rallied, yields have come off a little bit. And the chart of the 10-year yield, let's go there next, sort of makes me think about, sort of the buy on the dips methodology. Obviously, this is a yield, so it's not something that you would be buying. But if you look at the trend out of the August lows, right? So you sort of had the big puke out low in March, you sort of chopped around another pretty major low there in August. And from there, it's been this nice stepwise motion. This is, along with things like the TLT and the ag, sort of been in this shallow downtrend, lower highs, lower lows. Interest rates are going higher. So if you look and just draw a channel from the lows and a channel from the highs, we're at the lower end of this channel. So one of two things happens when this sort of environment occurs. Either you break down through that channel and it's indicating a change of character where interest rates are going from an uptrend to more of a downtrend. You have to break trend line support and then really confirm that with a breakdown through the 50-day moving average, I would think. Or option B, this is a buy on the dips, quote unquote, where you're sort of in a pullback, an actionable entry point along with further upside. So you've got resistance here at the June highs that we retested here early November. We break above that. That suggests much further upside. I would argue for interest rates in terms of the 10-year. A breakdown through trendline support, a breakdown through the 50-day might tell you a little bit different. Something like bond prices might actually hold up okay here. And you can see on the chart of the TLT how it's sort of the inverse of that, right? You see that this downtrend that's occurred since the August peak, lower highs, lower lows, testing the 50-day a number of times and rotating lower. This is at an interesting point because it's right at the 50-day moving average from below, right at the 38.2% retracement level from below. I think a rotation lower certainly looks to around 155, which would be the low from November, with further downside potential to 150 to complete that Fibonacci rotation. So, an interesting moment right now for bonds for sure. Last chart I want to start at, I wanted to finish off here on the macro was looking at the dollar index. So the dollar, and we didn't get a recap last week, so I'm sort of catching up on some of the things we would normally do in a weekly wrap show on a Friday, but we're retesting the September lows here and actually made a new closing low on Friday's session. So the UUP is actually trading up a little bit, which gives you a bit of a double bottom sort of pattern here. So it would not be surprising, given the fact that we're retesting those all-time long-term lows there on the dollar index, to get a bit of an upside rally. The question will be, obviously, is that the beginning of something more sustainable? Do we put in, a rotation higher and then a higher low, or is it a dead cat bounce before the next rotation lower? And getting below those September lows would certainly open up the door to further downside. I was often told early on, never confuse the bottom of the page with support. So even though this feels like a layup bottom, which I think in the short term it certainly could be, a breakdown of those support levels certainly could mean we could go a lot further to the downside. I lied. I have one more other chart just because Bitcoin has certainly been pretty volatile here, testing again 20,000 today, not closing above it. This is just the daily chart here of the Bitcoin index. So not quite getting above there and about 500 points below that key 20,000 level. And again, while that's a pretty arbitrary level, it certainly seems like a lot of people are watching that to see if Bitcoin will be able to eclipse that. And I think if you see it does eclipse that to the upside, if you do see further follow through to the upside, I think you could see an acceleration there. There's been a lot of volatility with Bitcoin, and certainly demonstrating that it can go a lot higher than the frame of reference you might have in mind. So some interesting charts, especially non-equity asset classes, things like Bitcoin. We didn't get to gold, but gold weaker with the other metals and interest rates. Let's continue on our discussion. We talked about the macro perspective. Let's get into sector rotation. As I mentioned today, technology was really the top. Healthcare actually improved going into the close. They're up about 1/3%. And after that, it was sort of everything else. And the real leaders to the downside, financials, energy, utilities. So financials and energy, not much of a surprise there, given the fact that they've accelerated to the upside. We're going to look at some of those individual charts. You'll see the overbought conditions that we got into last week and why today's pullback makes sense. And again, the question is this just a digestion move before we resume that uptrend going into year end? Or is this the beginning of, or is this the rotation away from that cyclicals trade that is pushed up to where we're at now? Let's look at the 11 S&P sectors using the relative rotation graph. So the RRG is one of my favorite ways to just look at the 11 sectors, how they're rotating around the benchmark in the middle. If you're unfamiliar with this, Julius de Kempener, my fellow StockCharts contributor, does a fantastic job. He created this methodology. Check out his show Sector Spotlight for more color on it. If you look at the weekly RRG, themes that you see are energy certainly rotating every week, continuing to accelerate to the upside. This is, today's sell-off isn't going to register much on a weekly RRG. It's really more meant to capture the long-term trends and really shows the acceleration that you've seen with energy, really from a confirmed downtrend to successive gaps higher on successive weeks into November, and certainly showing the potential to rally much further than many would have expected. Utilities, you saw, were down today, and you can see how that rotation has been the last couple of weeks, sort of had gone from a northeasterly direction, sort of a direction of improvement, sort of stagnant, sort of in line with the markets, and that's when it's at the y-axis, sort of what that means. To the right means it's outperforming, and the two best sectors according to this methodology at this point, I would say still industrials and materials by the fact that they're furthest to the right, followed by consumer discretionary and technology. The concern with these last three is that they're all rotating south to west, which I tend to call the direction of deterioration. It's not an improving relative trend. Even though they've outperformed, the momentum's kind of drying up. And so you see the rotation away from materials, away from consumer discretionary, away from technology. Financials has sort of come in strong to take up the slack. It's interesting to note that most of these sectors, save financials and energy, really rotating south or southwest. I should note communication services actually improving and rotating to the positive side within that weakening quadrant. It's an interesting thing to watch going forward, actually. Let's look at the daily RRG. This will capture a little bit of the short-term rotation and what's happening here. You see energy certainly has been the big winner, way far out to the right as a clear outlier, certainly showing the potential to continue to improve. I think when we look at the individual charts, and there are a number of them, but things that, ConocoPhillips, the integrated, sort of look like this, PXD and others. You see this rotation lower with certainly an opportunity to give back a little bit more of the gains before a potential resumption of the uptrend. But energy overall has been very strong, followed by financials, industrial. So all these that have been leading recently, all heading due south. So not getting worse, but not getting any better. Utilities and healthcare really leading the way down. You're seeing an improvement over here in the improving quadrant, consumer discretionary and technology. So the move we saw today with tech sort of reasserting itself a bit, semiconductors certainly continuing to impress. Overall, that's indicating, at least in the short term, a rotation away from these cyclicals like energy and industrials and back into things like tech and consumer, a bit of a rotation back to what we had seen before. Let's look at some of these sectors in particular. You know, with technology, it's an interesting one. Let's zoom in just the last year here to get a little more color. So you can see the improvement in technology up to the September high. Then you can see that choppiness through September and October, this narrowing of the range of sorts. You could draw this like a coil pattern, a symmetrical triangle, lower highs and higher lows. I'm sort of connecting the dots back to the July high. So for me, it seems more like a rotation around that 110 level. But I think either way, the interpretation is the same, which is you have this consolidation pattern. You've now rotated out of this pattern to the upside. You know, when you have a consolidation, you either break down through support or you break up through resistance, and we're seeing signs that that's what's happened. So step one, you break out of the pattern, which technology has done in the last couple of weeks. Step two, break above these swing highs. So I think a close above 125, which would take us above the October high, and then that swing high in November on the gap higher. That would certainly indicate a rotation back into technology. You see how the relative strength, it's been underperforming a bit. You know, again, if it follows through to the upside, I think we'll see that relative picture improve a bit, which would be interesting. I want to show energy and financials just to show the conditions I was talking about. Here's the rally that you saw in the XLE, taking it above the 200-day above trendline resistance. I'm going to add RSI on here just so you can see what I mean. Here we go, RSI, we'll put that at the bottom. So here's the overbought condition that we saw here with the RSI coming above 70. The last time that the XLE was overbought was back here in June. You see what happened there. This is when we rallied, gapped higher, the nice push higher just below 46, and that was it. That was the end of that move in June. Now, again, the fact that it's overbought does not necessarily mean we get a parallel move and we retest 28, although that could certainly happen. I'm not saying that can't happen, but the overbought conditions on its own do not tell you that. What it does tell you is that we're a bit overheated, and that's certainly what the market has felt like with extreme euphoric sentiment readings, with the extreme rally that you saw in energy and financial stocks. It is totally reasonable to have a pullback like we're getting today. So now it's all about what we do relative to key support, right? So we have first support level right around here. This is the Fibonacci level. It's around 3650. We'll see if that's able to hold through later in this week. If it does break that, I think you have to look back down here. A break below the 200-day, the trend line support will be the next sort of short-term level, but a move back to these to the next level down around 3080 could certainly be in the cards. Again, it's all about what it does relative to key support levels, because as long as it keeps making higher highs and higher lows, this is an orderly uptrend. And I think overall, you're seeing more strength than weakness up until today. The question is, what do we do on any sort of downside move? The XLF, similar sort of pattern, different configuration for sure, and already above the June highs, as you can see, but same as we saw with energy. You saw the peak in June when it tested the 200-day. That was the last time that the XLF was overbought. However, if you look back here, like in November of 2019, it was overbought as well. That was the beginning of the end. It wasn't the end. And so you could have this continued upside for these sectors through year end, even before some sort of further rotation lower. But it's all about the low. So on the XLF, 27 is a really important line in the sand to watch. Below there, I think the high in June, which lines up with this low in November, pretty important to watch. So some interesting sector themes. We're going to take a quick break, back with our next segment, shifting stocks. We'll see you in 1 minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We'd love to hear from you. We're going to do another mailbag segment on tomorrow's show on Tuesday. So we'd love to get your questions. Shoot us an email, the Final Bar at StockCharts.com, on Twitter at Final Bar SCTV, on our YouTube channel. Just put a comment below the video. We'd love to hear your questions. Hope to answer one of them on the air tomorrow. Let's get to our next segment, shifting stocks. This is the third part in our Monday process. We talked about the big picture, the macro rotations. We talked about sectors and how some of those leading sectors like financials and energy showing some weakness coming out of overbought conditions, technology coming sort of taking up the slack. The third part of my process is looking at individual stocks. We rarely have much time to go through a lot of them, but we'll get to some of them for sure. I wanted to start actually with Zoom. Zoom's reporting earnings actually as we're recording this, and it looks like in the aftermarket it's gapping down a bit based on the earnings release. So it'll be interesting to see as you're looking at this chart going forward. Again, earnings happen, and once a quarter, equities have gaps and have movements as a reaction to earnings. That's sort of an expected part of it. The question for me is always, what do we do relative to key levels? So when a stock is holding up okay, it's testing its 50-day from below, misses earnings, certainly going to expect some downside movement tomorrow. The question for me is going to be, can it hold 37? That's on an intraday basis, on a closing basis. That was the pullback when things like Zoom and Peloton sort of came off of their all-time highs here in mid-October. They all sort of pulled back and tested a Fibonacci line. I don't have that, but if you take the low in December, the high there, that's the 38.2% level. So it's a really reasonable point to find support. I wouldn't be surprised if we get a pullback there. And then the question is, does that hold? And if you like the long-term story from a technical perspective, that's a reasonable expectation for where a stock like that could potentially bottom. Let's continue on. Looking at communication services, Discovery is one I think that maybe tells the story of comm services right now. Disney, Viacom are all sort of in similar patterns to what you're seeing here. And basically what you're seeing is similar to the XLE and the XLF. They were overbought in June, came off of that overbought condition, pulled back to support, continued higher. You're seeing a similar pattern here, overbought, not quite out of that overbought region. I think the question through the remainder of this week is, does it come out of there? Same with Disney and others that have been overbought. Do they pull back? And then if they do, where's some clear support levels? This one's a little tough because it was just this nice, quick move to the upside. So for me, I always look back to the most recent breakout level. So that's the level at which buyers came in and decided that this stock was worth more than it had been before at its previous peak. So I think around 24.50 or so would be reasonable. 24.50 to 25 would be a nice downside objective if we do get that move out of the overbought conditions. The video game makers having a nice up move today with Electronic Arts up almost 3% on a down day for stocks. If you take the highs here from August and October, you're breaking out kind of nicely with today's move. And Activision ATVI is in a similar sort of thing, not quite breaking out of the trend line resistance, but I'm seeing both of those kind of come off of moving average support, rotating higher. So a bit of a follow through this week would certainly be of interest. Consumer discretionary, so many charts to look at. Gap is maybe an interesting one to watch out. This is one, pun intended, gap down after its move up to 27. That was the high here after this exceptional run when it was consistently one of the top 10 rated stocks in our scooter rankings for large caps. Now it's pulled back. It's pulled back to the 50-day moving average. For a lot of stocks, that's sort of that first test. Is it able to hold that 10-week moving average? If so, this is sort of that traditional buy on the dips sort of chart. Could be a really interesting one to get here. Also, if it does not hold that, you want to look at the RSI and see if it's able to hold the 40 level on the RSI, or does it break that? And at which point, all of a sudden, this starts to look a little more negative than positive. So we've already broken trend line support. Depending on where you draw that trend line off of the lows, that's strike one. Holding the 50-day is a really important one there. Amazon is a fascinating chart. I love this chart for a number of reasons, and I think if you very quickly here, if we draw some trend lines, the way I'm just sort of basically seeing this is it's similar to the chart of the XLK, to be honest with you, where you have lower highs, higher lows. I think this is, a pretty clear coil pattern consolidation. And one of two things has to happen here. Either we break above resistance or we break down through support. I wouldn't be surprised if that breakout direction is a good indication for the broader equity universe. I think if Amazon is able to break above 3,400, get above this trendline resistance, I think that signals the potential for much further upside for that stock, and it tells you that buyers are putting money into an equity that really matters. If it breaks down through 3,000, that's breaking down through this trendline support, breaking out of that pattern to the downside, and I think I would be concerned about overall distribution in the market if that happens. Now, granted, Amazon has not been a leader here since the September peak, and see the relative strengths rolled over. Overall, though, I think it's obviously a mega cap name with a lot of people interested in seeing what happens there. In terms of some other actionable charts, and again, I wish we could look at more, but we just don't have the time in 30 minutes. Hotel stocks had been some of those that had rallied significantly going into the November peak. You can see this really interesting gap higher and then trade lower. That's been the intraday high from that moment on here for Hilton. Marriott's kind of in a similar sort of thing in this short-term range between around 110, 115, and then 100 on the lower side. I think seeing if 100 can hold would be really, really key there. Otherwise, all of a sudden you're filling this gap. I think you have to be looking back down toward the 200-day and seeing more of a back end fill there. Etsy's an interesting chart, and again, this is one that's threatening. Broke to new closing highs on Friday. We didn't have a show, and it's one that came off of my weekend review, making a new 12-month relative high. Sort of flat for the day today, but overall, again, when stocks are sort of mid-range and pulling back, and something like Etsy is breaking out, I can find that to be pretty compelling. Consumer staples we're going to skip, but I think a lot of things are of concern there. Actually, let's not sleep there. Let's go there. Something like TAP is an interesting name maybe to watch here. I think it's really tempting to chase something like this coming out of the lows, and I get the argument for it. What concerns me is we're now testing the April high around 48. We've had this pretty strong run. The RSI is overbought and a bearish divergence of higher highs in price, lower peaks in the RSI. So again, while overall long-term this still could work, I think that's maybe suggesting a bit of an overextended move and potential for downside. You're seeing similar sort of configurations with stocks testing support, things like the tobacco names like Philip Morris, Brown-Forman, BF/B comes to mind as a similar one, testing resistance, and you're not sure whether or not that's going to eclipse it. That's all the time we have. So many individual stocks to look at. If you have questions on individual charts or an indicator you're looking at, just shoot us an email, thefinalbar@stockcharts.com. Maybe we can answer it in the show tomorrow. We need to wrap this show today and go to the 3 and 3, 3 charts, 3 minutes. Here we go. Chart number 1 is looking at breadth in the form of the S&P and the percent of stocks above their 200-day, percent of stocks above their 50-day. This tells, I think, 2 stories. Number 1, the fact that 92% of the S&P is above its 200-day certainly speaks to the broad advance we've seen, and it's things like financials and energy really participating that they had not done in previous moves. That's why this value has gone from about 5% at the March low to over 90% here. And again, each successive high, you've seen how this indicator overall has moved higher and higher. And this October move, where you saw a move, an increase in the number of stocks above their 200-day, shows you as the S&P's pushing higher, more and more stocks are participating. The concern I have now, and I think the second story, is that there are so many stocks that are up there, right? So many, over 9 out of 10 are above their 200-day. And while that speaks to strong breadth, for me, my contrarian hat starts to itch, and I think, all right, maybe that's not too many. And so I think if you look back, and again, I can't run the data right now, but what I would guess is that in the short term usually would line up with some short term pullback. I think when so many stocks go above their 200-day, that's not unreasonable that you'd see a bit of a downside correction, because it shows you how much of an upside we've had. But overall, I think that's more bullish than bearish in the long term. I bet if you look at returns 6-12 months out, and from talking to some of my peers in the industry that do that sort of work, that's sort of what that feels like to me. Chart number 2 is looking at the bullish percent index, which is $BPSPX on StockCharts. And, this is not signaling anything but a bullish trend at this point, which is about right. Bullish percent index measures what percent of the S&P 500 are in a bull signal on the point and figure charts, as opposed to a bear signal. And it's about 75% are in a bullish phase. That's pretty healthy. What tends to be unhealthy is when it breaks back below the 70 level. We call that a bear alert. And I think that would be one indication to look for. That's the pullback that you saw in September. That's what we saw in October. So if you think that the market is ripe for a correction, given the extreme, upside that we've had, this is one chart that I would look at to sort of validate that, because a break below 70 would tell you stocks are now rotating more into sell signals, and you're seeing stocks that are breaking down through intermediate or interim support levels on the point and figure charts. Finally is Amazon. I think this coil pattern is a really interesting one, not just for the stock itself and the general sense is whichever way it breaks, that tells you about the overall longer term trend, the direction of momentum, but I think also for the broader equity environment, whether a stock like that breaks to the upside or the downside. Folks, that's our show for today. Thanks for joining us on a Monday as we hit the market from all three directions: top-down macro, sector rotation, bottom-up stock picking. Get your questions, and we'd love to answer your question on our show tomorrow. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.